Hey everyone, Couch Investor back to another video for today. So obviously the hot topic of this week was Netflix, and now it's suddenly Bill Ackman. Because if you remember, back in February, he announced, Pershing Square Holdings announced that they bought a lot of shares of Netflix. They were all in on streaming. They believed in management and the future of the company. This week we had Netflix earnings. I did a video yesterday, top right corner if you haven't watched it. Yesterday evening after the market closed, suddenly announced that, they sold all their position in Netflix. So we're going to have a look at that in a bit. But the main point of this video is basically looking at his mistakes and how we can implement that in our investment journey, because it might not be such a bad thing to do. When you see something change, when you're not convinced anymore, the thesis might change for you. Just sell, cut your losses, and move on. So we're going to have a look at the whole letter and talk about what's written there. So it starts off, today we sold our investment in Netflix, which we purchased earlier this year. The loss on our investment reduced the Pershing Square Fund's year-to-date returns by 4 percentage points. Reflecting this loss, as of today's close, the Pershing Square Fund are down approximately 2% year-to-date. While we have a high regard for Netflix management and the remarkable company they have built, in light of the enormous operating leverage inherited in the company's business model, changes in the company's future subscriber growth can have an outsized impact on our estimate of intrinsic value. In our original analysis, we viewed this operating leverage favorably due to our long-term growth expectations for the company. Yesterday, in response to continued disappointing customer subscriber growth, Netflix announced that it would modify its subscription-only model to be more aggressive in going after non-paying customers. When he talks about the non-paying customers, he talks about those accounts that are sharing passwords. So the plus 100 million households that share other households' accounts. And to incorporate advertising as an approach that management estimates would take 1 to 2 years to implement. Now with regards to advertising, obviously it's going to take a while because this is something completely new for Netflix, not for the streaming industry, but for the company to start adding an advertising side of the business. Obviously, it's going to take a while until it gets going. So I understand why, even though they semi-announced that they're going to do it, he just wants to stay on the sidelines because, again, probably there's nothing going to happen with Netflix in the coming year or so. But when advertising does come, I do think it's going to be a positive catalyst for the company. He continued, while we believe these business model changes are sensible, it is extremely difficult to predict their impact on the company's long-term subscriber growth, future revenues, operating margins, and capital intensity, which makes total sense. That's why I said he prefers to be on the sidelines right now. But then again, why invest so much at once in February to only sell it all 1 quarter later for a $400 million loss? Anyways, continues, we require a high degree of predictability in the businesses in which we invest due to the highly concentrated nature of our portfolio. While Netflix business is fundamentally simple to understand, in light of recent events, we have lost confidence in our ability to predict the company's future prospects with a sufficient degree of certainty. Based on management track record, we should not be surprised to see Netflix continue to be a highly successful company and an excellent investment from its current market value. That said, we believe the dispersion of outcomes has widened to a sufficiently large extent that is challenging for the company to meet our requirements for a core holding. And he ends here, one of our learnings from past mistakes is to act promptly when we discover new information about an investment that is inconsistent with our original thesis. This is why we did so here. And this is something I'm going to touch on in a bit. We are in the midst of an opportunity-rich environment for Pershing Square due to the dramatic shift in Federal Reserve policy, the highly inflationary environment, geopolitical uncertainty, and the resulting high degree of security price volatility. We therefore expect to find good use for the Netflix proceeds. Please feel free to contact the investor relations team, blah, blah, blah. So I want to touch on one of the last points that they mentioned there, and the fact that it's okay if your original thesis changes, if you don't feel comfortable anymore with your investment, especially if it's a core investment, then it's okay to act promptly. Act fast, because if you don't act fast, then you might be a potential future bag holder and you're down, 50, 60, 70% or so. Now, it's obviously down considerably as well because of everything that's happening around the world, the market, etc. And in this case, Netflix business. But to take this lesson and apply it to your own investment journey is very, very important. If you have a core holding, and first of all, the mistake here was also that they went all in just like that, which is something I don't like to do. I like to build up my position, but since obviously my portfolio and his portfolio are completely different, but going all in and building your position up are two different things. If you build up your position over time and over time the thesis changes, then your hit won't be that big. But if you already build out your full position and suddenly the thesis has changed completely for you, like he said, they're not able to predict the future, which is a problem in his case, not really a problem for many retail investors because, well, we have time, we don't have to pay clients, etc. So it's important to act promptly. You don't want to be holding the bag. Let's say you bought something at $100. You were very confident. Suddenly, a couple of quarters later, it's just down 20%. But suddenly you see the thesis is starting to change. You do not sell, even though you don't feel comfortable. A couple of quarters later, you're down 60%. If you would have acted promptly, you would have been down only 20% and probably invested in something better or just held cash to build up the other positions out there. Now, to conclude, what they did is completely normal. Again, Bill Ackman, he bought Chipotle stock back in 2016, I believe. It was around $430 or so. Everybody laughed at him. Now it's around $1,615. So pretty good investment. They have some other, I believe Starbucks is in their portfolio as well. The list will be on the screen. So overall, take the lessons from him. He's a good investor. There are some great things you can learn from him. Obviously, they still make mistakes, even though they're billionaires and have years of experience. So that will be it for this video. Obviously, do let me know down in the comments below if you hold any of Ackmans or Pershing Square's Holdings shares. Let me know down in the comments below what you did with your Netflix stock. Did you buy? Did you sell? All in the comments below. And if you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. As always, guys, take care, stay safe, and see you all in the next video. Bye-bye.